According to the IMF, global growth is projected to be 3% for 2025. This is an upward revision from earlier on in the year, reflecting lower effective tariff rates, better financial conditions, and fiscal expansion in some major jurisdictions such as Germany. Also, inflation is expected to fall globally, but the headline figure hides specific country differences. For example, in the US, inflation remains above the Fed's target, with pressures from both wages and rents. Whereas in the Eurozone, inflation has moderated more visibly, particularly with price declines in energy. However, there are some risks on the horizon. Larger fiscal deficits and increasing government debt levels are of concern, not to mention the increasing geopolitical tensions which could see further disruption on supply chains, all of which could reignite volatility in financial markets. Generally, financial markets have performed well, leading to respectable returns for investors. Global equities continued their positive run after sharp declines earlier on in the year. The strongest performing areas in the third quarter were Asia, including both China and Japan. In terms of investment style, growth stocks led the way within the US market, but value areas such as banks have performed better within Europe. Smaller companies also had a strong run over the quarter. Within the bond markets, corporates showed resilience and spreads remained tight. However, the UK government bond market has been jittery, with yields rising on longer dated issuance, perhaps in reaction to what may be in store in the upcoming parliamentary budgets. Earlier on in the year, we reduced equities and trimmed some of the portfolio's growth exposure in favour of alternative investments where we could. This trade essentially limits some of the upside gains to be had from equities, but stabilises portfolio returns should we see a pickup in market volatility. We think this is a sensible position to hold, given some of the aforementioned risks. Ultimately, we are ensuring the portfolio is not overtly exposed to any near-term risks that we can foresee, while keeping enough risk on the table to meet long-term client outcomes.